There's a trillion-dollar market shaping your job, your mortgage, and your investments, and most people barely know it exists.
It's not the stock market. It's not crypto. It's the bond market, the quiet engine behind the global economy.
A bond is simple. One side needs money, the other lends it, with a promise to be repaid plus interest.
When people or businesses lack cash, they borrow. Bonds are just formal IOUs with rules and timelines.
Governments do the same thing. Roads, hospitals, armies, all require money governments don't always have.
Government spending creates jobs, boosts productivity, and eventually returns money through taxes.
Most government income comes from taxes. Only a small portion comes from other sources.
When spending exceeds income, the difference is called a budget deficit. Each year of deficit adds to national debt, the total amount borrowed over time.
By 2025, the UK owes trillions. The US owes tens of trillions. These numbers are enormous.
To raise cash, governments sell bonds to investors worldwide through regular auctions.
Banks, pensions, insurers, foreign governments, and everyday people are the buyers.
Government bonds are trusted because default would mean economic catastrophe for everyone. The coupon is the interest rate, the yearly payment promised to the bondholder. Maturity is how long the loan lasts before the principal is returned.
The coupon stays fixed, but yield changes because bond prices move constantly. When bond prices fall, yields rise. When prices rise, yields fall.
New bonds are sold in auctions called the primary market, setting the initial yield.
After that, bonds trade freely in the secondary market, where prices change every day.
Bond investors constantly predict inflation, growth, and future interest rates. Market interest rates reflect what investors demand today based on tomorrow's risks. When rates rise, governments must pay more interest on their massive debt. In the US, interest alone costs billions of dollars every single day. Much government debt is short-term, constantly rolling over at new interest rates.
As debt grows, more national income goes toward interest instead of public services.
To keep functioning, governments often borrow more just to cover existing costs.
Bonds are safer. Stocks are riskier because company values can collapse overnight.
Government bond yields are called the risk-free rate, the baseline for all investments. The extra return stocks offer over bonds is called the equity risk premium.
When bond yields rise, stocks become less attractive and investors rebalance. Corporate bonds carry more risk than government bonds because companies can fail.
The gap between safe and risky bonds is called the credit spread.
When that spread widens, it often signals stress in the financial system.
The bond market doesn't just reflect the economy, it actively controls its speed.
If this helped you understand bonds, like, subscribe, and share. Knowledge compounds too.